Friends, one of the features of IFA Galaxy's Knowledge Summit is to get collective intelligence through a group discussion. And we're going to have that again this year. This year, we're going to have a very interesting topic. The topic is return a factor of risk management or portfolio construct? And it's a topic that's worthy of being debated. And to moderate such an important topic, we have another celebrity among us, none other than Shyam Shekhar, a dear friend of mine from school days. Shyam is well sought after by all the media. You turn the TV, you turn the Economic Times, Shyam is right there in a very prolific Twitter handle that Shyam has. His advice and knowledge is sought after by one and all. Shyam runs iThought, another respected investment advisory firm, and Shyam is the star today who's going to moderate our group discussion. The floor is yours, Shyam. Over to you.
Friends, welcome to this very interesting panel discussion. The topic we have is return is a factor of risk management or portfolio construction. Increasingly, when we look at an actively managed fund, we are very much wanting to see portfolio construction, and we want to see excellence in how stocks are picked. And that gives us the confidence to invest in active funds. We also want to see something unique, something which is unique to the fund house. So we are looking for differentiators. In that process, we find that we probably may be emphasizing too much on portfolio construction and how fund managers curate and manage portfolios. This naturally leads to our lack of adequate focus on the risk management. From the advisory side or from the MFD side, this is something which should bother us in the coming days. So in that sense, this topic is a very interesting and a very relevant topic. We have with us 4 experts who are going to speak to us on this topic and who are going to give us insights into what is happening in the market and how they have viewed this issue or handled it within. Firstly, I'd like to introduce the participants. We have with us Mr. George Joseph, CIO and CEO of ITI AMC. We have with us Mr. Mohit Bhatia, Head of Sales of Canara Robeco. We also have with us Mr. Mayuk Datta, who is the Head of Products from Mirai Asset Management. And we have with us Mr. Ravi Somasi from CAMS. He is the VP Operations, and he is also going to join us in this program. So without much ado, I'm going to open up this discussion, and we are going to invite Mr. Mayuk Datta to first give his views on this subject.
Okay. So good evening, everyone. Good evening, Shyam sir. Thank you to you for having me on this panel and to all delegates and members at the committee at the IFA Galaxy. It's always a pleasure to be associated with the IFA Galaxy for these sessions. Quick point as an opening, I would say that there are 2 parts to which I would say when the word risk comes into for all investment portfolios. One could be a risk in terms of portfolio designs. One could be the risk at a scheme or a financial planning design. So I would assume that most of our viewers who are practitioners are actually designing portfolios which are taking care in terms of risk for our investors. We can probably delve on that more. From the manufacturer's point of view, a risk is always a factor which needs to be kept in mind when you're designing a portfolio. Had it not been for risk, mutual funds would not be there because it is a diversification is taken to be a risk mitigation exercise. Many times we need to be also careful mitigation by not only market cap definition, but actually there is risk mitigation by portfolio design, and that's where that sort of a product comes in. So those would be my opening statements to talk about 2 different parts when the audience can look at risk. their own design when they create portfolio for investors, and when as manufacturers we create the portfolios. So you're mute.
So you are saying that handle it at two levels. As an advisor or MFD, you are also a manager. So at your level, you can mitigate the risk. Choose the products and fit them into the overall, portfolio need of the client. That's precisely what you're saying.
Yes.
So on that note, in a highly volatile space, let's say like small caps, how do you think it is important? How much do you think it is important to control the spikes in risk? And do you think that it is being done in a way which mitigates the volatility?
So I would say that in that sense, in small caps, all small caps fund are same because they would be investing from the 251st company onwards. So in that sense, most of the portfolios, the investable universe is constant for everybody. It's actually the risk mitigation is possibly in terms of what sort of a concentration or a tail each portfolio carries, which is basically a fund house's view. Their sizing up is a big issue. There is a liquidity dearth when it comes to the small cap universe. So the size of the fund, the sizing of portfolio, number of stocks definitely makes a sense. There is also one part which I would say that many times in equity portfolios, what is the actual holding beyond the prescribed limits of actually gives you your experience of risk. What do I mean by that? Today, if you have a 65 to 70% small cap holding in most small cap portfolios, is the rest 25-30% mid cap or large cap is going to totally change your experience of the portfolio. That is where possibly you as a practitioner come into the fact that is that combination making sense or not. This is also true for hybrids also, where if you had a mid cap and a credit mixture, while you are coming in for equity and debt and thinking it will be a risk mitigation exercise, you are actually having the most riskiest or volatile part of both worlds. So that is where the practitioner comes in to be very cognizant of what sort of mix is he or she getting and does it suit his investor or not.
While on the note of hybrid funds that you mentioned, there could be a time when both the asset classes are not going to fire like we are seeing in the immediate future. How do you think any practitioner can actually deal with this?
I think it's very important to understand that in a hybrid space, when an investor comes in, he or she is anyway saying that I am not okay with the volatility. There is a reason why they would have come for it. Or it could be also for an investor who's looking for a one-stop solution. Both of them are looking for a similar experience. One is not coming for a volatility, another wants a convenience. Rather, if they were to do it separately, it would be a different experience. They would like some sort of auto rebalancing and others coming. That is when a practitioner understands the requirement. Now to translate it into mechanics, I would say they would look at it, what has been the behavior of the fund during extremes. How was the fund sized up? How was the fund allocated during low interest rate regimes when equity would have done well? How has the fund behaved when interest rates are spiking up? What was the sizing up of the portfolio on the debt side? Are they carrying what they have been stating as a philosophy? It's very important for a practitioner to look at the finer prints and the behavior of the fund, because that experience will give them some sort of an inkling of how the future can hold and what are the go areas and not go areas from A portfolio to B portfolio, and then see which one fits which investor.
I'm going to ask you another question, which is a comparison between hybrid funds and asset allocation funds, the dynamic asset allocation funds.
Sure.
Given that risk management is becoming so very important, do you feel that the asset allocation funds have a better and a more flexible mandate, which helps them do risk management in a way which does not lower the quality of their portfolio construction? Do you think that hybrids are actually at a disadvantage over asset allocation funds?
So I would say a hybrid is something which is more like a fill it, shut it sort of asset allocation, where the asset allocation is being kept constant. So for somebody who has a goal which is slightly ahead in time and would like to eventually in, let's say, 5 years or in 10 years, want to reach with a certain asset allocation, and they would like that to be constant. That is where a hybrid definitely scores over most of that. I would say that is a good space to be in. Possibly that can also become somebody's core portfolio, where over a period of time, a 70-30 or a 60-40, just for example, will be a good asset mix to have, even if somebody's life goals or age or with income, you move different life stages in life, but a 70-30 or a 60-40 means that you are there and you are participating on both sides, and a certain amount of risk mitigation has been built on in the allocation. A dynamic product is predominantly from a not an asset allocation but a volatility solution. That during volatility, how has been the volatility been reduced? The impact has come down for an investor in their portfolio. Typically, a dynamic asset allocation sort of product has therefore appealed more to a debt plus investor, where the volatility and a slightly much lesser volatility than equity, but a slightly better experience than debt has happened. While for an equity or for an SWP investor, hybrids have turned out to be better solutions.
Thank you so much. And now I would invite Mohit Bhatia to give his comments on the topic.
Good evening, Sham, and to all the members of the IFA Galaxy. Thank you for inviting us here, and it's great to be part of this panel and discussing this very interesting topic of what really is responsible for returns. Is it risk mitigation, or is it security selection or allocation? So I think this question keeps on coming up and has become relevant even more during these recent years, given the upheavals we've seen in the market-linked products. Yeah, so I think ultimately, whether you look at the institutional level, which is basically mutual fund investors or manufacturers like ourselves, or if you look at advisors like yourself who are advising clients, ultimately the whole point of portfolio construction basically is to ensure that you have your division between asset classes and securities in such a way that you have cash when you need it. For example, for an institutional investor where markets are at maybe screaming valuations, you want to invest, or you need money at the time of redemptions coming in, cash is available. You're also protecting from deep drawdowns, that can happen when markets go down. And finally, you're also in line in terms of consistency of returns. I think that's what is the purpose, whether at the institutional level or at the retail level, of doing the portfolio construction. That said, I think I believe that these are not mutually exclusive things. So, we have this, anybody who picks up a finance book, and, I think all of us have gone through that, exercise of doing our MBAs or higher studies, or even under the basic, undergrad studies. We know that higher the risk, higher the return, whether you pick it in a formal way or a informal subconscious play, or what I would call as heuristics or mental models that investors and people have in their minds. Typically, higher risk is associated with higher return, right? So they are in a way conjoined twins. And it is also, I would take the analogy of sports where, examples of, say, tennis, where, you can be a great player delivering aces, but, you can't win a match if you're committing too many unforced errors. And that's where the importance of risk mitigation comes in, So I think in today's days and age, to ensure consistency of returns, which is what we are looking at for investors, it is important that you manage risk in a way. It is outlined in the scheme objectives, and Mayuk pointed about earlier in his discussion on scheme objectives, and how today in a great move by SEBI to categorize schemes, and therefore have a very clear classification amongst various products that are available in the market from various mutual fund manufacturers, right? So that brings about clarity, where the scheme objective specifies as to what is the kind of risk levels you can take, right? Over and above that, you can also have internal limits, which I'm sure each AMC, including ourselves, we have. So, that dictates what kind of risk you can take in a portfolio, and the portfolio construction, therefore, also results in a way from the kind of level of risk you can take. So that said, I think two essential things that will form part of a requirement from an advisor or from a manufacturer, and this is what exactly I think investors are looking for, whether from their AMC provider or from advisor, is one, alpha creation, or in a more, I would say, day-to-day relatable basis, consistency of returns. And second, a control on deep drawdowns. So, without kind of going in for a detailed research, I think we can, there'll be enough and more votaries for investors or distributors who vote for consistency of returns rather than too much of variability or a season of great returns followed by a few seasons of declines. So I would say that both these things are essential today. And as I mentioned, these are to me co-joined twins, where you have both need to be kept in mind and be designed in line with what is the scheme objective, right? Just to add here, so I would also refer to, because the topic is quite interesting and, detailed when you said return is a factor of risk management or portfolio construction. So, I would also refer to this study which was done in 2000 as a follow-up study to the very famous 1986 study on asset allocation and is it responsible for return. So that's one of the investment maxims that we've all grown up on. But, I think it's important to understand the nuances there. So, for example, a lot of people believe that asset allocation explains, 90% of the return. So, well, that's not true. It explains the standard deviation of returns in a portfolio, which means the risk inherent in a portfolio versus itself, what it promised, is explained by asset allocation. In fact, the study in 2000 that was, done on the similar topic, which compared performance of balance funds in the US over a period of 15 years, came out with this conclusion that asset allocation is responsible for about 40% of the returns, other things coming in from selection, timing, costs, and everything, right? And the level of returns are, of course, decided by asset allocation, which means, you can't expect to generate equity-like returns and beat inflation by remaining in a cash fund, right? So you have to take that level of risk. So why I'm bringing in this here is that ultimately, the level of risk gets decided in a fantastic way in our mutual fund industry, where the scheme objective tells you that, okay, this is the kind of risk level that is inherent in this asset allocation, and hence you will basically construct portfolios around it, right? Also taking a moment to address one of the things that you had mentioned and asked Mayuk also. Yes, I think in areas of mid-cap stocks, small cap stocks, also true for fixed income securities, I think it is very important to manage the concentration and liquidity risk. So each company, each AMC has, some of these, I would say, rules which are kind of inbuilt over and above what the regulations kind of provide for. But yes, I think specifically when addressing mid-cap and small-cap portfolios in a product like mutual fund, where investors from all segments of the country, all levels of income, all levels of demographics come in, it's important to make sure that the concentration and liquidity risk are very well managed. So, that's a slightly detailed part on the first question that you had.
I have a question to you. See, your fund house in the recent years has a very effective track record of high conviction investing. You have a philosophy and you have a certain orientation towards quality investing. So a lot of your investments are, concentrated in the sense not within the portfolio, but everybody who believes in your philosophy, and you're not alone, there are others also who believe in the same philosophy, are all in the same space. So while your portfolio per se may not be crowded, the space is very crowded. There is no room for mobility or maneuvering. When people want to leave or when they want to sell out of the same stocks, who goes to the exit door becomes a problem. How do you ensure that your portfolio construction is resilient to somebody else who believes in your set of stocks actually selling aggressively? How do you respond to that? Because we are now facing that test right now as we speak. So how are you going to keep the portfolio construction resilient to the risk management of your peers? Let's say somebody else who has the same philosophy as you has a redemption, or he has to sell on behalf of his clients. So suddenly what happens is these companies which are very, very resilient in valuation look vulnerable. Like today, a colleague of mine was pointing out that the trade is 0.5% of the market cap of a company, but the stock has fallen 6%. So he's asking why this has happened. And the answer is very simple. The answer is that you are as good as the most vulnerable investor in your camp. So given that the quality camp has become very, very crowded, how do you deal with this risk?
Yeah. No, I think a very valid question. And I think something that I mentioned in my first part of the response here, that we are very, very particular about ensuring, and there are, so I'll give you some examples. So for example, in the mid-cap holdings that we have across all our funds, whether the mid-cap is held in a flexi-cap fund or in the large and mid-cap fund, or even in the small-cap fund, some portion that we have, the mid-caps are restricted to 3.5% of the overall portfolio size. We also make sure that even if there is a passive breach, as in these stocks appreciate in value, it is brought down to a level which is within these limits. And then secondly, in the small cap space, which again becomes, you have enough examples where liquidity truly dries up. I think we also make sure that we don't hold more than a certain percentage. I can't disclose the exact amount, but yeah, we don't hold beyond a certain percentage of the outstanding equity of the company. The purpose there being that we don't want to become market makers for a particular stock. We have a fiduciary responsibility on behalf of the investors, and we are here to basically invest, as per the mandate, but also make sure that we don't run into a liquidity risk. In addition to that, we also make sure that the average trading volumes on a rolling basis over a certain period of time are monitored on a day-to-day basis, right? So this ensures that if we spot a fall in trading volume, the holding is again linked to that. Again, not possible to discuss the exact ratios here, but yes, if we see, the basic rule here is if we see falling trading volumes on a rolling basis, we make sure that we are cutting down position in those stocks, which may look qualitatively great. So that's the risk management element that comes into play when we are managing these. And besides this, I think on the large cap side, there seems to be sufficient liquidity given that there is a very large number of players in the market. And we don't foresee any situation like that in the large cap space. But yes, of course, you have the regulatory limits which ensure that each and every security doesn't, or any of the security doesn't go beyond a certain permissible limit. Yeah. So. So basically, what I would say is that we are on the other end, that we don't believe in concentrated portfolios except for the focused equity fund that we have. If you see all our holdings, all our schemes, you will see very diversified portfolios. A flexi cap would have maybe 55, 60 stocks. Small cap will have similar number of, 55, 60 stocks. The idea there being that, you don't want to venture into a space where you're unable to move out of that, because these are open-ended funds. And so one of the pillars that we follow as part of our investment philosophy is to ensure that the NAV really reflects the underlying value or realizable value of the securities. I think that's one thing that we keep in mind in terms of pillars, both on the fixed income side and the equity side.
Yeah. Thank you, Mohit. I'm going to ask our third guest something very different. We have with us Mr. Ravi Somasi, VP Operations of CAMS. Ravi, why don't you tell us what you have observed in the last couple of years during the COVID phase about what is happening with investors, what is happening with their behavior, and what your data and your insights are telling you. Over to you, Ravi.
Thank you so much and good evening, everyone. At the outset, I would like to congratulate all the MFDs, all the distributors for adapting to the new normal during the COVID period, number one. And number two, they always ensure that the investors are serviced well. It has become a new normal, but yes, even before the COVID phase also, we had two trends, if we can see. One, the gradually the penetration into mutual fund industry or the investments that are coming into mutual fund industries were on the growth path. And two, the mega trend of the digital mega trend. These are the two things. So if we flip the discussion topic, say return is a factor of risk management or portfolio management. If we see and relate the return to the mutual fund distributor's return, that is his own commission, and the investor service. So we have been seeing the trend of more money and more investors getting into mutual fund industry over the past few years, even before the COVID, and the digital mega trend. So with these two things, I would like to present some of the insights which I could see. Looking at the first trend, that is preference to mutual fund products or mutual fund category, it has been on the uptrend thanks to the mutual fund distributors who have been putting tremendous efforts to getting new investors to the mutual fund industry. The individual investor AUM had, actually has been outpacing the institutional AUM, the growth particularly. Retail and HNI together is much higher than institutional. SIPs have grown tremendously in the last few years, and of course, industry currently has over 5 crore SIPs, out of which almost like 2.2 or over 2 crores got added in the current financial year itself. Some of things, even if we see the paper and paperless, that is the digital mode, if we see the paper mode, which was at a higher percentage, has come down to almost like 20%, and everything now is happening through non-paper mode. B30, particularly the AUM, if we see, it has doubled or more than that in the last 2 years. If we look at the opportunities, so where the opportunities lie actually, if we look at the opportunities for the distributors and for the industry, mutual funds, in spite of whatever growth we had seen in the past years, it is still an under-penetrated category. There is a tremendous headroom available. We have only little over 3 crores of investors as of today, whereas we have about 50 crore PANs in the country. Then we have our AUM, little close to 40 trillion, which is representing only 15-16% of our GDP. We still have about, in the advanced countries, almost like this mutual fund AUM is about, say, 60, 70, 75%. So if we look at the other side, how distributors can build their own portfolio in the sense of their own AUM, there is a lot of opportunity existing with their own investors, because if we look at the industry, almost like 74% of PAN members have only single SIP. So there is a huge opportunity there, and it's a huge untapped cross sell upsell opportunity. And most of the times, the personalized or hyper personalized products are getting investors are getting attracted as against the general distribution or distribution of general products, and most importantly and equally leveraging the technology for prompt efficient after sales service. There are some more numbers like some more points like retention of their AUM. If we look at the retention of their AUM during the difficult times like the COVID lockdown, be it the second lockdown, and in the first lockdown, all of us suffered a lot. So most of the people had actually used SIPC's option. if we look at the options that are available, we also have SIP pause option. So distributors can go back to the investors and educate them. Yes, it's a different time. We understand. You need not cease your SIP, but you can, pause your SIP as long as you want. That is one. And if we look at the SIP growth, SIP has become a new, what is it called, growth, a new mode for distributors as well as all others in the market. It has been contributing a lot. They have grown by 92% as compared to the previous years. And if we see SIP via digital and non-paper has increased to 80% from 20%. So this is few points around the SIP route and leveraging the SIP pass against SIP Cs, and you can build few other ideas with these clues so that you can retain your AUM intact, or you can it can go under pass for some time, but yes, definitely it will come back. So that is one. And if we look at on the technology thing, the growing trend, the digital mega or the digital mega trend, if we see, we have the technologies like connective technologies, the security tools, and digitized processes. So if we look at the connective tools, we have video conferencing, chatting, co-browsing that allow the advisor and investor to build a trusted relationship, because nowadays we can't go, the distributor cannot go to the investor's place, or investor cannot come to the distributor place. So the co-browsing technologies and the video chat conferencing and all those things will work. The security tools like secure email and e-signature, voice identification, facial recognition, whatnot. We have everything in a mobile phone nowadays. Then digitize the processes. Of course, all of us, the AMCs, RTAs, and everybody, they are building, the digitized process. Even for the complex things like bank mandate and all, we have built much before the pandemic period itself. So these are some of the things around which they can look at. If we see the new investors that are coming, the paper, if you look at year 2019, 53% or 54% was through paper, and 47 was through digital. If you look at by end of last year, 77% was through digital, and the rest is, so there is a major shift in the route. And I also would like to say that distributors uh, onboarded more investors through electronic platforms or media, the websites or the mobile apps in the last 3 years, even a year before the pandemic, that lockdown time also. All that started a year before. Actually, it helped us a kind of, like preparing us for an unknown thing. So, and it is still increasing. 56% or close to 60% of the investors brought in by mutual fund distributors in the last few years. I'm not talking about the lockdown time 2020, or even before that also, a year before, are under 35 years of age. So if we look at these millennial investors, and they are brought into the industry by the distributors. So their expectations are different, their needs are different, and in a nutshell, the distributors have to provide a digital experience. It is actually not a new normal. It has actually become a normal a couple of years or a year at least before the pandemic record itself. So in this, in a nutshell, to close the what is it called, the points here, there are three things. Technology will only further intensify, and three key aspects will be growing your business, managing your data, serving your investors. These are the three key points: leveraging the technology, and most importantly, as of today, all the new investors that those are being acquired by the distributors, good 60% are under 35 years, and they are all millennials. So I request distributors to understand these trends. See, most of the times we don't even have time to understand or analyze what kind of population is coming into mutual fund industry through me, how many of them are millennials, how many of them are young, or how many of them are old, or so all these things will take little time for the individual distributors to analyze, understand. So with these data points, I hope it will be insightful and they can build upon from here with these points. So that's it from my side. If you have any questions, you can. You're on mute.
Thank you, Ravi. I think it was very interesting to hear from you that digital and physical have inverted in these 2 years. And today, digital is almost 77%, you had mentioned, and it probably go all the way even to 90-95% over the next 1 or 2 years. So that's clearly telling us that younger people, new people coming to the market are engaging with products and organizations very differently. And naturally, their aspirations also will be very, very different from the old school, and the advisors and MFDs must also adapt in such a way that they are able to offer their knowledge and services in a way in which it impacts this audience. And that is something very, very relevant, and that is very, very important for us as a takeaway from what you said. Now, I would invite George to speak on the topic, and he's going to tell us how return is a factor of risk management or portfolio construction. Over to you, George.
Hi, thanks, Shyam, and warm welcome to all of you for for this particular event, and thanks for inviting me to IFA Galaxy. First and foremost, we have to understand that we are in a world living where you have seen that massive number of changes happens on a daily basis. You have seen that globally we are well connected, and therefore whatever happens globally, it has an impact on the markets as well as the bearing on the investments what we do. If you see the clear path that market participants are following, there is a momentum path, there is a path of value, then there is a path of growth. So when I think about all these aspects today, as we see the number of participants who are following momentum and the kind of money which is chasing because of the algorithmic trading and practices followed across the globe. Almost, I was reading somewhere that 60% of the money which is chasing Indian markets is because of algorithmic factors. That is a huge number, and that increases the volatility and the risk in the markets. So these are all not human brains which is working behind it. It is machines working behind it, and there are certain set algorithms which works and hits the market at different points in time. And if it is a momentum algorithm which is working, and which is predominantly most of the algorithms are linked to momentum, you will see that the volatility increases. So 15 days, we have seen 40% correction in the market in March 2020, and in my view, that kind of situation is going to increase substantially as we move forward. We could see a day that 10 days, market correcting 40% also. So this was not the game, previously. So therefore, the volatility has increased. Volatility is nothing but risk. And when you think about the portfolio construction from this perspective and to generate returns in the whole scheme of things, you need to think away from the crowd, and you have to create a portfolios accordingly, and you have to deal with underperformance and outperformance at different points in time. Many times markets go through exuberance and market goes through extreme pessimism, and it's like a pendulum swinging from one side to the other, and that will keep happening. During this phase, how do you create a portfolio and how the risk can be managed? So according to me, and what we have thought through at ITA Mutual Fund is that we have set up certain basic fundamental rules which will help us to think about the businesses, and which has helped me in my career of investing for the last 30 years. What has worked for me and where I have blown up my money also. So thinking from those aspects, We have put a very simple three-letter word, philosophy. We said that, what we believe in, we have to put it across. That is, we call it as SQL. So S stands for margin of safety. For whatever you buy, you have to buy it cheap. That is as simple as that. Q is quality. Quality of the business is subjective to each and every person. The quality is in the eyes of the beholder. But nevertheless, the quality can be very, substantiated on various parameters. Maybe good business model, the company which is able to generate and create cash and grow the business, and also it can be, run by very strong management. For various aspects goes into the quality curve, and how they have dealt with the capital allocation over a period of time. All these things talks about the quality aspects. And then the low leverage. So L is for low leverage, which is nothing but, if the company is highly indebted and it is having huge amount of debt in the books, then the company can actually go bankrupt any day, because the corona can come, and you can see that, suddenly Ukraine war can happen, and these things are not in the control of the company. The commodity prices can go through the roof, and the inflation go out of hand. Then the company which is indebted is definitely in trouble. So business cycles is becoming shorter, and during these business cycles, companies can go bankrupt, and we have seen some of the telecom companies going bankrupt, or at the verge of bankruptcy and things like that. So if you have more debt, that's a problem. So these three things is, basically we believe in, and we have put it as a philosophy which helps in our entire risk management process. So we think from the same lens, we look at the debt market also. Debt also, if you say, if it is safety is important, and quality is important, and liquidity is important. So leverage, we have turned it up to liquidity. So we said that SQL is important in bond market also, and debt market also. And we have seen irrational exuberance, as I mentioned earlier, in the markets, and which has been heightened by because of these kind of market participants coming in, and the policies keep changing. Suddenly you will say, the policies coming from SEBI as well as AMFI and various other bodies suddenly changes the entire paradigm of investing also, especially from the mutual fund perspective. So suddenly you change the T+1 settlement to T+2 settlement to T+1, and it has its own impact. And you say that the margin requirements in the market is 50% instead of 20%. Suddenly there is an impact. So all these things adds to the complications and the volatility. So what we believe is, we need to have a stringent risk management framework, within the company, within the fund, when we are running different schemes, because each scheme has a mandate defined by SEBI, and adhering to the mandate, we need to have certain principles to be followed over and above the broad principles of what we said. So every product, we have a mechanism to control the quality curve, control the safety net, and also control the leverage. So we have decided that this is something which is inherent to our investment philosophy as a fund house, and let's look at each product wise also, that is followed or not. Now product wise, when we are following, we have defined the mix between the safety, quality, and leverage. What mix each fund should have, and what is a quality curve? Now, if I say, for example, quality perspective, there are 1,500 stocks listed in the market. We defined it as a A, B, C, D category of stocks, based on certain fundamental parameters on which you define, saying that this is A category stocks, there's B category, looking at the history and looking at various aspects. So we have identified some 50 odd parameters on which we define these matrices, and then say that these are all different categories of stocks falling in in A, B, C, D. Now that A, B, C, D mix is defined between the schemes. So that itself controls the risk. Now portfolio construction, for when you are talking, the topic is about portfolio construction, I thought I'll just give a flavor of how we look at the portfolio construction. We have ABCD metrics. We have a quarterly rating metrics for the companies, how the business are doing well in the marketplace. Thirdly, we look at the overall overarching investment philosophy SQL in place. All put together, then beyond that, the SEBI limits of how much percentage exposure you can have in the group and stocks are very much in place. All put together, I think it is a fairly robust system, which you need to have to adhere to the market situation. Now we have to understand that markets are, volatile because of the market participants' emotional challenges, right? So suddenly market will become happy and suddenly market will become sad. So in this kind of environment, the risk on risk off happens in the equity market as well as debt market very often, and it is increasingly becoming risk on risk off, that phases are coming very fast and furious also. So how you deal with that kind of situations? So every company has to, in my view, has to adopt to certain principles what they believe in, and set up certain processes so that you can circumvent these kind of environment very smoothly and ride through the volatile bit, then finally create a very robust portfolio. If you do this way over a period of time, maybe 1 year, you might be a sharp underperformer. But at the same time, over a period of 3 year, 5 year, 10 year, based on our analysis, it suggests that you can be a clear winner without risk, no return. And without, when you take risk, there is a chance of going wrong and going underperforming when exuberant period. Just to take an example, in the recent past, the IT sector was going through the roof, right? It was a 10-year high valuations the sector is running. People didn't want to leave IT sector. They're saying that growth is happening, that is happening. There are so many things which is in favor. But suddenly what happened in last 2 months, the stocks have corrected almost 20% in no time, right? And that can, and still I believe that there's a humongous froth left in the sector. And looking at the prospects, people jump into it, and there is a herd mentality which is very much seen for 4 months. You have to be away from the sector. How calibrated way you move away from the sector is important, to make money in the long term. But the problem is that the entire chasing of returns concept, which is very much there in the market, specifically for mutual funds, daily return, weekly return, monthly return, that concept itself takes the risk paradigm to a different level. When I look at some of the small cap category, that is a very risky category. It's like playing with fire. But at the same time, that's one of the area where you can create humongous returns if you diligently deal with it. But how you deal with the risk category in different market caps, like small cap, you limit the fund house. We have said very clearly at the time of launch of our fund itself, we don't want more than 1,500 crores in a small cap fund. So you can limit yourself. It depends upon the fund house risk appetite. What kind of volatility that you want to handle for your investors. So overall, portfolio construction as well as return, and as well as when you think about the risk parameters that you want to run in the fund house level, I think it is it is all interlinked, and but at the same time it has to be thought through well while setting up the overall overarching principles in the company, as well as thinking about individual schemes that you run. And also you have to mix the whole aspect with when from the fund management point of view, you have to think from the business cycle situations as well. Like say for example, 1990 to 2000 we saw the technology, media, telecom boom. Then there was a massive crash, and 2000 to 2010 was infra boom. Then there was a massive crash. And 2010 to 2020 was a consumer centric businesses boom. Now that has its own way of playing out. For you have to think in what will work the next 10 years. So some sort of macro thinking plus the cyclical business cycle reversal or the trend reversal aspect you have to think through, and what can work for every decade. It can be very different. So thinking from that perspective also is important from the managing the overall risk framework for the organization. This is what I want to talk about. And from background of fund management where I come from, and where we have set up the mutual fund in the last 3 years. This is what I would like to talk about.
Thank you, George. I'm going to come back to you with some questions, but firstly, the first question is related to what I think is very, very successful in the last 5 to 10 years in the AMC business, and also for the IFAs and MFDs, that is curation of conservatively managed products. I think the products which are conservatively managed have done extremely well, and I'm sure that we have 3 AMCs here. If you see the products which have done very well, they are actually curated with some conservatism in the early stages, and that became the philosophy. And you have yourself been associated with the dynamic asset allocation product for a very long time, so you also are very familiar with conservatively curated product. And do you think that it's better to control risk management in product curation, or you think it's best left to the fund manager? Since you're the only fund manager here, I'm going to ask you this question.
I think it's a process. As a process has to be set for every product. How will you manage the risk in that product, and and also the portfolio construction part. So if you have an overarching principle at a fund house level, so that you will not run behind fintech when they're everyone is talking about fintech, and if you see that the largest insurance company is coming with IPO, then you think that insurance, whether it is getting leaked out. So these thinking will automatically help you to curate yourself at a fund house level. But product level, I think definitely there is thinking required. Fund manager can work in that ambit, and he has to align with that ambit what you have said, and say that when I mentioned that for example, I'm just taking an example like a multi-cap category of funds. If I say that the A, B, C, D rating that I give for different stocks, and it is a well thought out, debated mechanism at which we said that we'll rank the we'll say that the companies are in these categories. Now I can define a mix of A, B, C, and D for multi-cap, so that automatically the fund manager will think, if I say A and B together should be 80%, then if he's selling 5%, he's at already A and B together is at 80% in the fund. And if he's selling 5% from the fund, he has to think that I have to buy an A and B category stock only to reach 80%, right? So he will not directly go to D category. So that way, the controlling of through a process is required for the fund or a scheme as a product level. But at the same time, fund manager also has his own abilities of deciding what works best, and within the ambit how to perform. So I think it is important to control at the product level also, and some leeway definitely you have to give to the fund manager to think. So I am only saying that A and B should be this much, and I'm not saying that which sector he has to pick.
I got your point. I think you have added one more layer to what I said, and you have said that the process curation will also control the product very effectively. And I have seen that in the products of several companies, and it was a pleasure to talk to all of you who have such principles incorporated in your products and what you offer, both the MFD fraternity, the advisor fraternity, and the do-it-yourself investor. So in that sense, you've all been offering a much wider gamut of products, and these products come with superior processes, and naturally they are better placed to offer risk management on a sustained basis. I'd like to especially thank Ravi for giving us insights on what is happening in the industry, and it was a pleasure moderating this session. Thank you very much, and have a nice evening.
Thank you.
Thank you very much.
Thank you.
Thank you, Shyam sir. Thank you, everyone. Have a nice week.
Yeah.